You need new work boots. The cheap ones at Payless cost $40, and they'll last maybe 6 months before the sole separates and the leather cracks. The good ones at the work supply store cost $120, and they'll last 5 years, maybe longer. You know the good boots are the better deal. 5 years of good boots costs $120. 5 years of cheap boots, replaced every 6 months, costs $400. You're not stupid. You can do that math. But you have $40 right now, and you don't have $120 right now, and your current boots have a hole in them, and your feet are getting wet. So you buy the $40 boots, again, and you'll buy them again in 6 months, and again 6 months after that. Over the next 10 years, you'll spend $800 on boots. The person who could afford the good boots spends $240 for the same 10 years of dry feet. You paid $560 more than they did for the exact same thing. That's not a hypothetical metaphor. That's the poverty tax. That's why being poor costs more than being rich. And if you've ever had to buy the cheap version of something because you couldn't afford the good version, even though you knew the cheap version would cost you more in the long run, this video is for you. Let me tell you what this feels like. Because if you've lived it, you know. You're standing in the grocery store comparing prices. The big container of laundry detergent is $12, and it'll last you 3 months. The small container is $5, and it'll last you 3 weeks. The big one costs $4 per month. The small one costs $6.60 per month. You know the big one is cheaper. But you have $17 in your checking account until Friday, and you need detergent today, and you also need milk and bread and gas to get to work. So you buy the small one, you pay the poverty premium. Or you need to cash your paycheck. The check cashing place charges you 3%. That's $15 on a $500 check. A bank account would be free, and you could deposit the check for nothing. But you can't get a bank account because you bounced a check 4 years ago and you're in check systems. So you pay the $15 every 2 weeks. That's $390 a year to access your own money. Or your car breaks down. The repair costs $800. You don't have $800. You could put it on a credit card, but your credit is bad, so your interest rate is 24%. Or you could take out a payday loan at 300% interest. Or you could try to limp along with the broken car and hope you don't get fired for being late to work. None of these are good options. All of them cost you more than they would cost someone with money. That's the feeling. That's the trap. You know what the smart choice is. You know what would save you money in the long run. But you can't make that choice because you don't have the upfront capital, or the credit, or the time, or the access. So you make the expensive choice over and over again, and you get poorer every time. Here's what nobody tells you when they give you advice about money. All the advice assumes you have money to start with. Save 10% of your income. Buy in bulk. Invest in quality. Build an emergency fund. Max out your 401k. Get good insurance. All of that advice is correct. All of it will save you money and build wealth. And none of it is accessible if you're living paycheck to paycheck with nothing left over. The advice isn't wrong. It's just not for you. It's for people who already have enough. And that's the cruel joke of poverty. The less money you have, the more everything costs. The more money you have, the cheaper everything gets. Rich people get discounts for paying cash. They get interest on their savings. They get rewards points on their credit cards. They buy once and use for years. Poor people pay fees for not having enough money in their account. They pay interest on everything. They pay more for car insurance because of their credit score. They replace cheap stuff over and over. The economy is designed to reward people who have money and punish people who don't. And if you're on the wrong side of that equation, it doesn't matter how smart you are or how hard you work. You're paying more. Always. Let me show you the math, because once you see the numbers, you can't unsee them. Let's build a budget for 2 people. Person A has money. Person B doesn't. They're both buying the exact same life, but person B pays more for every single piece of it. Housing. Person A owns a home. Their mortgage payment is $1,200 per month. Person B rents an apartment because they don't have a down payment for a house. Their rent is $1,400 per month. Same housing, but person B pays $200 more every month. Over a year, that's $2,400. Over 30 years, that's $72,000 in extra housing costs. Plus person B has no equity, while person A owns an appreciating asset. Transportation. Person A bought a reliable used car for $15,000. They got a car loan at 4% interest. Their payment is $275 per month. Person B couldn't get approved for a car loan because of their credit score, so they went to a buy here, pay here lot and got a car for $12,000 at 18% interest. Their payment is $350 per month. Same transportation need, but person B pays $75 more every month for a worse car. Banking. Person A has a checking account with no fees. They get interest on their savings. They have a credit card that gives them 2% cash back. Person B pays $10 per month for a checking account because they can't maintain the minimum balance. They use a prepaid debit card that charges fees for everything. They cash their paycheck at a check cashing place for 3%. Person A is making money on their banking. Person B is paying maybe $40 per month, $480 per year, for the privilege of accessing their own money. Food. Person A shops at Costco. They buy the big packages. They stock up when things are on sale. They cook at home. Their monthly grocery bill is $400 for high-quality food. Person B shops at the corner store because they don't have a car to get to Costco and they can't afford the membership fee. They buy the small sizes because they can only afford what they need today. Their monthly grocery bill is $550 for lower quality food. Same calories, but person B pays $150 more per month. $1,800 per year. Healthcare. Person A has employer-sponsored insurance with a reasonable premium and deductible. They go to the doctor for preventive care. Person B has a high deductible plan or no insurance at all. They skip preventive care because they can't afford the copay. When they finally get sick enough that they have to go to the emergency room, they get a bill for $3,000 that they can't pay. That bill goes to collections, tanks their credit score, and makes everything else more expensive. Insurance. Person A has good credit. Their car insurance costs $100 per month. Person B has bad credit. Their car insurance costs $170 per month for the same coverage. Same risk, same car, but person B pays $70 more per month because insurance companies use credit scores to set rates. Added up, person B is paying $200 more per month for housing, $75 more per month for transportation, $40 more per month for banking, $150 more per month for food, $70 more per month for insurance. That's $535 per month. $6,400 per year. That's $6,400 that person B is spending just to exist at the same level as person, not to live better, not to get ahead. Just to have the same housing, the same transportation, the same food, the same insurance. And this doesn't include the emergency costs, the medical bills, the car repairs, the payday loans, all the other ways being poor costs extra money. This is just the baseline poverty tax. Over 10 years, that's $64,000. Over a lifetime, it's hundreds of thousands of dollars. That's the cost of being poor. That's why people can work full-time, follow all the rules, make smart decisions, and still never get ahead. Because the game charges them extra just for playing. Now here's where it gets even worse. That $6,400 per year poverty tax isn't just money person B doesn't have to spend on other things. It's money they don't have to save. It's money they don't have to invest. It's money that doesn't compound. Person A, who's paying less for everything, has extra money to put in a retirement account. That money grows at 7% per year. Over 30 years, it becomes a nest egg worth hundreds of thousands of dollars. Person B, who's paying more for everything, has nothing left to invest. At retirement, Person A has a portfolio and a paid-off house. Person B has nothing and is still paying rent. The gap isn't just $6,400 per year. The gap is compounding over time. It's the wealth gap, and it starts with the poverty tax. The boots theory isn't just about boots. It's about how every single economic transaction punishes poverty and rewards wealth, and how those punishments and rewards compound until the gap becomes unbridgeable. So why does this happen? Why does everything cost more when you have less money? It's not an accident. It's not bad luck. It's the structure of the system. Let's break it down. First, the credit score system. Your credit score determines how much you pay for almost everything. Good credit gets you low interest rates on loans, lower insurance premiums, better rental terms, and access to rewards credit cards. Bad credit gets you high interest rates, higher insurance, security deposits, and fees. But here's the problem. The things that damage your credit score are the things that happen when you're poor. You miss a payment because you didn't have the money. You have high credit utilization because you're using credit to survive. You have a medical bill in collections because you couldn't afford to pay it. Your credit score drops, and now everything costs more, which makes it harder to pay bills, which damages your credit more. It's a trap. And the credit score system isn't measuring risk in a neutral way. Studies have shown that credit scores are better at predicting income than they are at predicting whether you'll pay your bills. They're a proxy for wealth, and they're used to charge poor people more. Second, the inability to buy in bulk or invest in quality. This is the original Boots theory. Quality items cost more upfront, but less over time. Bulk purchases cost more upfront, but less per unit. If you can afford the upfront cost, you save money in the long run. If you can't, you pay more forever. This isn't a personal failing. This is a capital constraint. Poor people aren't buying the cheap boots because they're bad at math. They're buying the cheap boots because they don't have $120 right now. The system rewards people who have capital and punishes people who don't, and it's not just boots. It's cars, appliances, furniture, clothes, food, everything. Cheap versions break and need replacement. Quality versions last. But quality requires upfront money most people don't have. Third, predatory pricing and service deserts. Companies know that poor people have fewer options, and they charge accordingly. Check cashing places cluster in low-income neighborhoods because they know people there can't access traditional banks. Payday lenders set up shop where people are desperate. Rent-to-own stores charge triple the retail price because they know their customers can't afford to pay up front. Even regular retailers charge more in poor neighborhoods. Studies have found that the same grocery chain charges higher prices in low-income areas than in wealthy areas for the exact same products. Why? Because poor people have less mobility, fewer transportation options, less time to shop around. They're captive customers. And captive customers pay more. This is called price discrimination, and it's completely legal. The market isn't fair. The market is extractive. It identifies people with the least power and charges them the most. Fourth, time poverty. Being poor takes time. You wait in line at the check cashing place. You take 3 buses to get to the cheaper grocery store. You spend hours on the phone trying to get your medical bill reduced. You work multiple jobs to make ends meet, which means you don't have time to cook from scratch, so you buy more expensive prepared food. You don't have time to shop for better insurance rates or compare loan terms. Time is money, and poor people have to spend their time on survival tasks that wealthy people can pay to avoid. This creates a double bind. You could save money by cooking at home, but you don't have time to cook because you're working 2 jobs. You could save money by shopping around for better prices, but you don't have time to shop around because you're working. You could save money by doing your own car maintenance, but you don't have the tools or the space or the time to learn. Every money-saving strategy requires time, and time is the thing poor people have least of. Fifth, the safety net as poverty trap. Government assistance programs are designed with massive cliffs. If you make $1 too much, you lose hundreds of thousands of dollars in benefits. This creates effective marginal tax rates over 100%. Taking a raise or working more hours can actually make you poorer, because you lose more in benefits than you gain in income. So people stay in low-wage jobs, turn down raises, limit their hours, all to stay below the income threshold. This isn't laziness. This is rational decision-making in a badly designed system. The benefits cliff is a poverty trap, and it keeps people stuck. And even when you're receiving benefits, they're not enough to live on, which means you're still paying the poverty tax on everything else. You're still renting instead of owning. You're still paying check cashing fees. You're still buying the small detergent bottle. The assistance helps, but it doesn't eliminate the structural extra costs of being poor. Sixth, asset poverty. Wealth isn't just income. Wealth is assets. If you own a house, you can borrow against it at low interest rates in an emergency. If you have a retirement account, you have a cushion. If you own a car outright, you're not making payments. Assets create options, and options create savings. Poor people don't have assets. They have income, if they're lucky, but no accumulated wealth. This means every emergency is a crisis. A $400 car repair that a wealthy person pays out of savings becomes a payday loan for a poor person. The wealthy person pays $400. The poor person pays $400 plus $150 in interest and fees. The gap grows with every emergency because one group has a buffer and the other doesn't. And building assets is nearly impossible when you're paying the poverty tax on everything. You can't save for a down payment when you're paying an extra $6,400 a year just to exist. Let me give you a specific example that ties all of this together. Let's say you're working full-time at $15 an hour. You bring home about $24,000 a year after taxes. Your rent is $1,400 per month, $16,800 per year. You now have $7,200 for everything else. Car payment, insurance, gas, food, utilities, phone, healthcare, clothes, any emergency that comes up. $7,200 for an entire year. That's $600 per month. Now you need a new car because yours died. You can't afford a reliable used car for cash, so you need a loan. Your credit is bad, so you can't get a bank loan at a reasonable rate. You go to a buy here, pay here lot. They sell you a 10-year-old car with 120,000 miles for $12,000 at 24% interest. Your payment is $350 per month. You now have $250 per month for food, utilities, gas, phone, healthcare, and everything else. You're spending 140% of your non-housing income on a car. This is unsustainable. But you need a car to get to work, so you make the payments for a few months. Then the car breaks down. The repair is $800. You don't have $800. You can't get a credit card. You take out a payday loan. Now you owe $800 plus fees due in 2 weeks. You can't pay it in 2 weeks. You renew the loan. More fees. You're in a debt spiral. Within 6 months, you've paid $2,000 in payday loan fees on top of your car payments, and you still owe the original $800 for the repair. You fall behind on rent. You get evicted. You lose the car because you can't make payments. You lose your job because you can't get to work. This isn't a hypothetical. This is the lived reality of millions of people. And at every single step, the system charged extra for being poor, the high-interest car loan, the payday loan fees, the eviction court costs, the job loss. None of this would have happened if you'd had $15,000 to buy a reliable car outright, or good credit to get a reasonable loan, or a savings cushion to cover the repair. But you didn't have those things because you're poor. And being poor costs more. So what are you supposed to do? How do you escape the poverty tax when the system is designed to keep charging you more? Here's the hard truth. Individual action can help at the margins, but it can't solve a structural problem. You can make smart choices and still be trapped because the deck is stacked. But that doesn't mean you're powerless. It just means the solutions aren't simple. First, minimize the poverty tax wherever you can. This is hard, but every fee you avoid is money in your pocket. If you're paying check cashing fees, look into second chance checking accounts or credit unions that serve people with banking history issues. If you're paying overdraft fees, opt out of overdraft coverage and use cash or a prepaid card. If you're buying small quantities at high per unit prices, see if there's any way to pool resources with friends or family to buy in bulk. If you're paying rent-to-own prices, buy used from Craigslist or thrift stores instead. These aren't solutions. These are tiny adjustments that save small amounts. But small amounts add up when you're living on the edge. Second, build any buffer you possibly can. I know this sounds impossible when you have no money left at the end of the month. But even $20 set aside is $20 you don't have to borrow when something breaks. Even $50 in a savings account is $50 that might prevent an overdraft fee. The goal isn't to save your way to wealth. The goal is to create a tiny cushion that prevents the worst-case scenario. Because in the poverty tax economy, the worst-case scenario is always more expensive than the regular scenario. Getting evicted costs more than paying rent. Losing your car costs more than fixing it. Getting your power shut off costs more than keeping it on. A small buffer can prevent the cascade of fees and penalties that make poverty spiral into destitution. This is survival finance, not wealth-building finance. It's different math. Third, protect your credit score like your life depends on it, because financially, it does. Pay your bills on time, even if you can only pay the minimum. Keep your credit utilization below 30% if you have credit cards. Don't let bills go to collections if there's any way to avoid it. Check your credit report for errors and dispute them. A better credit score won't make you rich, but it will reduce the poverty tax. It'll get you lower interest rates, lower insurance premiums, better rental terms. It's the difference between paying an extra $6,000 a year and paying an extra $3,000 a year. It's still a tax, but it's a smaller tax. Every point your credit score goes up is money saved. Fourth, use technology and resources strategically. There are apps that help you avoid overdraft fees by spotting you small amounts. There are programs that help you build credit by reporting your rent payments. There are food banks and community resources that can reduce your grocery costs. There are earned wage access programs that let you get paid before payday without payday loan fees. None of these are perfect. Many of them have their own fees or strings attached. But they're often better than the alternative. The poverty tax economy is predatory, but there are also people and organizations trying to create off-ramps. Find them, use them. They won't solve everything, but they might reduce the bleeding. Fifth, if you have any opportunity to increase your income, take it. This sounds obvious, but the poverty tax makes it complicated. As I mentioned, you can lose benefits by earning more. You need to do the math. If a raise or a second job will net you actual additional money after accounting for lost benefits, increased taxes, and increased expenses like childcare and transportation, do it. If it won't, don't. But if there are opportunities to increase income without triggering benefits cliffs, pursue them aggressively. Learn skills that pay more. Get certifications that open doors. Job hop for raises. The poverty tax is a percentage of your spending, so if you can increase your income faster than your costs increase, you're making progress. It's slow, it's hard, but it's math. Sixth, recognize that this is structural and political. The poverty tax exists because of policy choices. Credit scoring systems that use wealth as a proxy for risk. Lack of regulation on predatory lending. Housing policy that makes homeownership inaccessible. Minimum wages that don't cover the cost of living. tax policy that favors wealth over work. Every one of these things is a choice, and choices can be changed. Vote for policies that reduce the poverty tax. Support candidates who want to cap interest rates, expand access to banking, build affordable housing, raise minimum wages, close benefits cliffs. Organize with other people who are paying the poverty tax. Collectively, you have power. Individually, you're vulnerable to extraction. Together, you can demand change. Here's the bottom line. Being poor costs more than being rich because the system is designed that way. It's not an accident. It's not natural. It's not your fault. You're not paying more because you're bad with money or because you make bad decisions. You're paying more because you don't have the upfront capital, the credit, the time, the access, the buffer that would let you pay less. The Boots theory is real. The poverty tax is real. And it costs poor people tens of thousands of dollars per year, hundreds of thousands over a lifetime. That money doesn't disappear. It goes somewhere. It goes to landlords and check cashing places and payday lenders and buy here, pay here lots and insurance. Companies and all the other entities that have built business models on extracting value from people who can't afford to say no. You deserve better. You deserve an economy where $1 of income gives you $1 of purchasing power. Not 87 cents because 13 cents goes to fees and premiums and extra costs. You deserve an economy where quality is accessible, where credit is fair, where housing is affordable, where banking is free, where one emergency doesn't destroy your life. That economy is possible. It exists in other countries. It existed in different eras of American history. We can build it again. But it requires seeing the poverty tax for what it is, a systemic extraction of wealth from poor people to rich people, enabled by policy and enforced by market power. It's not natural. It's not inevitable. It's a choice. And we can choose differently. If you're living this right now, if you're buying the cheap boots and watching them fall apart, if you're paying the fees and the interest and the premiums, I want you to know you're not alone. Millions of people are trapped in the same system. You're not failing. The system is failing you. And while individual actions can help at the margins, real change requires collective action and political will. So yes, do what you can to minimize the poverty tax in your own life. But also recognize that you shouldn't have to. The game is rigged, and unrigging it is the work of policy, not personal responsibility. Fight for that. Vote for that. Organize for that. Because you deserve boots that last. And you deserve not to pay $40,000 for the same pair of boots that cost someone else $8,000. That's not personal finance advice. That's justice. And it's long overdue.